You have shared your opinion that you don't believe that there is a credit policy and that it died with the establishment of the Washington Consensus. What does the absence of a credit policy mean for African development?
Thank you. So the Washington Consensus that came to the African continent in the 1970s and 1980s, pushed by the IMF and the World Bank, was a policy paradigm that said you have to let the market allocate credit, you have to let the market allocate capital, and in order for that to happen, you have to privatize state-owned companies, you have to privatize state-owned banks, and you have to liberalize your trade, your labor markets, and you have to make your central bank independent and targeting price stability. So this means that credit policy is fundamentally inconsistent with the idea of an independent central bank and with the idea that it is the market that allocates capital, not the state. Because credit policy fundamentally means that the state says, I have identified a series of sectors, like the agricultural sector, like the renewable energy sector, like, manufacturing sectors, and I would like to provide preferential loans to these sectors. That is credit policy in the sense that the state directs the flow of credit without asking the private banking system whether they think it's a good idea or not. And this was part of the early experiments with developmental states in Africa and elsewhere, part of a bigger idea that the state has to direct the development, it has to direct the upgrading of productive structures. In order to do so, it needs state-owned banks, it needs state-owned companies, it needs to work closer with the private sector, and it needs to do industrial policy with credit policy hand in hand. So to me, if we want to have a new form of a developmental state, a new form of state-led development, and I think that's the only form of development you can have credibly these days, you cannot do it without credit policy, because you have to ask yourself, where is this investment going to come from? Where is credit going to come from? And you cannot rely on the private banking system and on the private credit system to deliver on credit to your strategic ambitions, to your strategic sectors.
Mm-hmm. And let us into the politics behind how we got here. Mm-hmm. And I think you also touched on the fact that the global north did develop with strong credit policy. So let us into the politics behind all this.
Very good. So when we think about why is it that credit policies disappeared, one way of thinking about it is to say, well, economists realized that theoretically it is wrong to have credit policies. The credit policies are wrong because they create financial repression. So we got rid of credit policies because there is a kind of objective economic theory that says you shouldn't do it. But to me, there is the more important reason, there is not such an economic theory that can provide an objective basis for discarding credit policy. There is, however, a political economy behind it, which says for countries in the global north, under the Washington Consensus, there was a vision of what development looked like. This vision was the development can only be provided by the market. It was a vision that benefited fundamentally corporations in the global north because it reduced the capacity of the African states to create the kind of industrial policies and the kind of credit policies that would allow them to develop autonomous local manufacturing capacity. So there is a political economy logic behind it that basically says, I want the international trade system and I want the global value chains to be dominated by my corporations. This is why we see the struggle between China and the United States now, is because China did not follow this recipe for very long historical reasons, and it showed to African states and other countries in the global south that you can develop it by doing credit policy, and you cannot develop by doing credit by completely foregoing your ability to direct credit flows.
And let's dwell on that a little bit. The defiant states who did not adopt the Washington Consensus and went their own way, how were they able to stay on course, and what has been the results of adopting credit policy? How did they go about it, and how can African countries emulate that?
Right. There are people behind. So I'm reading. The question was how was China able
to stay on course?
To stay on course how could it be a defiant state against this Washington consensus, and how did it? What can African countries learn from it?
Yeah.
So I would say two things. First, there is a long history of China experimenting with different models of transition from a centrally planned economy. We have to remember that China transitioned from the centrally planned economy and decided to do capitalism. And they said, we will do the kind of capitalism that we know countries in East Asia, our neighbors, did in the 1950s and 60s with the support of the United States, because the United States was so scared then that communism will spread to South Korea, to Indonesia, to Thailand, that they allowed them to do developmental policies. They supported credit policies. They supported industrial policy simply as a geopolitical move to protect capitalism from the threat of the Chinese and Russian central planning, right? So China, of course, has many experiments with doing capitalism. The one that was most successful, and I refer to the industrial policy introduced in 2015 called Made in China 2025,
right, which
is a spectacularly successful industrial policy that has a credit policy very strongly attached to it. It did it because they managed to combine two things. They managed to, because of the scale of the economy, to persuade foreign corporations to invest in China first, because they had cheap labor and good conditions, but they managed to convince them to do technology transfers. And a lot of the Chinese, if you look at the Made in China 2025 industrial policy strategy, the logic behind it, it says, we want China to become a technology powerhouse, not a cheap labor powerhouse. We don't want it to just be the cheap labor economy for the rest of the world. We want it to become a technology powerhouse. And to become a technology powerhouse, we need to grow our own local companies. Mm-hmm. We need to force foreign companies to transfer technologies to our own local companies. We need to bribe them to transfer these. And we need to have credit policy. And if you look at the scale of credit support for local Chinese companies who are now technology leaders in clean tech or technology leaders in train manufacturing, everywhere you look, there is massive state support. People usually say, China is a special case. African countries cannot do it because they're too small, or because they don't have the resources, or because they live with large public debts. I think these are all valid concerns. Right. We have to recognize that, replicating the experience of China doesn't mean basically you take the blueprint of what China did and you apply it to African economies. I'm not suggesting that. What I am suggesting is that the fundamental logic of credit policy and of state-led development is true in terms of the ability of those countries to go up value chains, to create manufacturing capacity. It's true in China, it's true in East Asia, it's true in the countries in Africa that did some form of industrial policy for a little while. What it needs two things. It needs first a change in the way that we think about credit flows in the economy. It's about the way in which we think about central bank independence. Right. And it also needs, and this goes hand in hand, and perhaps this is a more difficult job, it needs state capacity to do credit policy and to do industrial policy without political capture. And I'm saying this from the experience of my own country, Romania, that this is a big ask, but we have to dream the impossible. We have to dream of the impossible, that the state is able to create its own bureaucracies, its own state, its planning agencies that can be functional. The countries have done this for a very long time. There is no reason for us to believe that the state is just a corrupt set of institutions. Yes, I'm using the word corruption because there is a lot of corruption in my country. There is a lot of corruption in the global north. There is a lot of resistance to state interventions, but we cannot simply give up the state because we have bad experience with certain state forms.
Mm-hmm. And finally, and making things a little more practical, in Nigeria, we have some sort of industrial policy where we're putting Nigeria first, right? Mm-hmm. Nigeria made goods. For example, there's a local refinery that has been established now, 650,000 million barrels per day, I beg your pardon, by Dangote Refinery. And we're doing as much as we can to protect that and focus on patronizing that local industry first. So that's a policy, industrial policy in a way, that we're coming up with Nigeria first. How can we, you mentioned, you put some sort of nexus between credit policy and industrial policy. How can we back that up, that Nigeria first policy, with a credit policy to strengthen the drive?
Very good. So having local capital managing local commodities and the export of even fossil fuel commodities, I think it's very important because it reduces the extraction of commodity profits by foreign corporations. And we need a lot of countries in the global south who are very commodity rich end up either losing a lot of commodity revenue to the foreign owners of those commodities, or suffer from something called the Dutch disease, which is that they allow these foreign revenues without an industrial policy. They allow it to appreciate the exchange rate, and they allow it to create kind of headwinds against local industries. I mean, this is not, if I'm correct, this is not the case of Nigeria, because the pressures are going in the other way towards the depreciation. But the lesson, I think, is that it's not enough to have more local capital in charge of your local commodities and in charge of commodity extraction, manufacturing or processing and export. You have to ask yourself, what do I do with this sector, and how do I create linkages to other sectors which are not so volatile to the terms of trades in the changes in the prices of the commodities? And we know this for a very long time, that this is a vulnerability for countries who are commodity dependent. But we essentially creating a nexus between commodity sectors and manufacturing sectors, where you can improve your ability to manufacture locally the goods and that are consumed locally or that are exported. So credit policy is important in that story of trying to build your own local manufacturing base, because it can be used as a tool to make sure that your local capitalists do what the state wants them to do, rather than the state does what the local capitalists do. This is kind of the complex. With credit policy and industrial policy, the idea is that the state is in the driving seat, and it tells local capitalists, I give you support, Nigeria first, but Nigeria first, not you first, right? Not local Nigerian capital first. That is, to me, the very important question is, next, how do you structure the relationship between the state and the local capitalists, where the state is in the driving seat and has the power to impose direction, to say, I want you to do this kind of investment, I want you to meet this performance criteria, I want you to diversify and improve my export capacity beyond fossil fuels, beyond refining oil. Because this, in 10 years' time, I would say, with the scaling up of the Chinese manufacturing of renewable capacity, fossil fuel exports, fossil fuel commodities are going to suffer a significant terms of trade shock. It's not, don't look so worried.
Yes.
This should be like an opportunity to think very carefully about, fundamental institutional change, and creatively, okay, we need a different model of state-capital relations.
Thank you very much, Daniela Gabor. Did I get that?
Very
yes.
good, very good.
Professor of Economics at SOAS University of London. Thank you for your time.
Thank you.